Hi, good afternoon. My name is Kiana Montgomery, and I'm a licensed mortgage loan officer with TAM Lending. My license number is 125-1855. So now that we got that out the way, I just wanted to talk to you guys. I'm going to be shooting some videos that are going to cover a lot of the aspects of the loan process. It can be very arduous, and a lot of terminology gets thrown around, and you can get really lost and not understand what's going on. So, what I want to do is inform all the watchers of what different terms mean and how they play into you getting approved to buy a home, because once you understand the process, it makes it that much easier. And I believe that everyone that wants to own should be able to own, and you can. It's just about education. So we're going to start out this first video talking about DTI. Have you ever heard that term before, DTI, and wonder like, what is that? What does that mean? And then when you find out DTI stands for debt to income ratio, you still kind of like, what's that mean? What is that? Perfectly fine. Most people don't know what that is. That's why I'm here. So we're going to go over DTI today. So like I said, DTI stands for debt to income ratio. So let's start with, what is debt? A lot of times when I ask people, what are your debts, they think of debt as you're delinquent or something. So when I say, what are your debts, they're like, all my stuff is paid on time. And I'm like, no, no, no. Debt is anything that you owe someone. So it's all loans, whether you pay them up or later and whatever. If you owe any money on a car loan, student loan, a credit card, personal loan, anything like that, even a timeshare, these are debts, because you, until you pay it off, you owe someone. So all of those factor into your debt. So now that we established what debt is, now we have income. Now, income, people think they know what their income is, which that's different when you're talking to a mortgage loan professional. We talk about qualifying income. So what does that mean? Why is there certain income that's not qualifying? So qualifying income just means the income that we can count in your debt to income ratio. So things like, if you work a second job and you haven't had that second job for at least 2 years, we can't count that income. So while that's income, it's not qualifying income. So it helps you maybe to get approved, because it's a positive thing that you have that extra income, but we can't count it in our calculations. So those are the type of things that uh, will come into play when we're talking about qualifying income. So income is regular pay that you receive. It has to be reported to the IRS. So unfortunately, qualifying income does not include if you're paid by cash under the table. So it's very important that you think about all these things when you get ready to think about buying a home, because that can really, keep you from getting approved. So qualifying income, like I said, is the income that's reported to the IRS and that we can count, qualifying income. So now that we have those two terms explained, now what is debt to income ratio? So ratios is basically just comparing the two and seeing how much percentage of the other it is. So your debt to income is how much debt do you have in comparison to your income. So how does this play into the whole approval process? So it's really important, because think about it logically. If you have a person with a lot of debt, a lot of different people they owe, it would be harder to it'd be more riskier for you if you loan them money to think that you're going to get your money back, because they owe so much money all over the place. So that's what the lenders think about. And they have a limit of how much debt they will allow you to have to your income. Now, to go back to debt, to clarify, debt does not include your monthly bills. Debt only includes loans and things that you owe to companies. So it doesn't include your utilities, but it does include your car loan. It doesn't include your car insurance. So these are the type of things we can get into a little bit more if you had more questions about that. But just to clarify what is considered debt. So the banks have a limit of how much debt they allow you to have, and that's why they want to look at this debt to income ratio. So in general, they want your debt to income ratio to be somewhere between 40 and 50%. That depends on your credit score. So the higher your credit, the higher they allow your DTI to be. So now you start thinking like, wow, that's how credit plays a part in it. And we could talk about that more later. But you just start to see how the better your credit is, the more you can afford or get approved for with the same income. So let's get back to the actual calculation. So we'll use 50% because that's the easiest. But like I said, it can be anywhere from 40 to 50%, maybe lower, depending on your what type of purchase you're doing, and also what your credit score is. So we'll use 50%. So if they only allow 50% DTI, that means that your debt cannot be more than half of your income. 50%, half, right? So let's use some numbers. So when we calculate DTI, we do it on a monthly basis. So that's the other thing that people might not know or understand. So we're looking at your debts on a monthly basis and your income on a monthly basis. So when we're looking at your debt, we're looking at your monthly car note, not what the balance is, but what do you pay every month. The same thing with your credit cards. It's important how much you owe, but it's also important what's the minimum payment that you have to make every month. So we add all those figures up, and then we take and compare that to your income. So your total debts have to be half of your income. So that means the new house that we're thinking of approving you for has to fit in that 50%. So if you make $60,000 a year, then your income monthly, because we look at before taxes are taken out, so that's the great thing. We're looking at your gross income. So if you make $60,000 a year, we divide that by 12, and you're making $5,000 a month. You at 50% DTI limit are allowed to have debt up to $2,500 a month, and that's it. So if you have $2,000 a month already of debt between school loans and car payments and credit cards and all these different things that you can rack up, now you only have $500 left for your mortgage. $500 probably will only get you about $60,000 house. So now that's limiting you. So we'll talk about things when I have clients meet with me. We'll talk about things like paying down their debts so that they can get approved for more. It's being very strategic. So we can get into that on a personal level. If you hit me up, I can talk to you and analyze what your debt to income ratio is and help you get your debt to income ratio within a lower limit so that you can get approved for the most house that possible. That's my job and that's what I do. But I want to inform people and be educated on how this whole process works and all the terms that are used. So I'm going to be doing some more videos. This is just the first of many, and we covered DTI, debt to income ratio. If you have any questions about what I covered or want to talk about anything else, you can friend me on Facebook. I'm Kiana Montgomery, Qiana Montgomery, Montgomery. Friend me, and I'd love to talk to you more. We can exchange information through there. You can message me. I want you to follow me on Facebook, because that's where I do a lot of my stuff. And stay tuned to my YouTube channel, because I'll be having more informative videos just like this one. So I hope you guys have a great and productive day, and we'll be talking soon.